All right, it looks like the waiting room has calmed down for a minute.
Okay.
So what I might do is we might kick off and then people can join as they can. So, welcome everyone. Thank you so much for joining our Lunch and Learn session today. Today's session is going to be on getting the most out of your super. Firstly, I'd like to begin with acknowledging the traditional custodians of the many lands of which we're meeting from today. As this session's online, we recognise that people are joining from a variety of Aboriginal and Torres Strait Islander lands across the country. We pay our respects to elders past and present and extend that respect to all Aboriginal and Torres Strait Islander people joining us today. Please feel free to share where you're joining from in the chat, but we will get going now. So today's session is going to be presented by Renee Rainbow from Vision Super. Thank you so much, Renee, for joining us and running this session today. But I'm got not much else to say other than just if you have any questions, please post them in the chat. And I'll assist Renee and we'll get to them when we have a moment. So Renee, I'll hand over to you.
Thank you. Well, again, thank you so much, everyone, for allowing us to come on board and run these sessions. So I'm a client partnership manager at Vision Super. And just to give a little bit of background, because I understand quite a few of you are from New South Wales, on the 1st of March, Active Super and Vision Super merged together. So we're all now under the one heading of Vision Super. So because of that, effectively, Vision Super is the industry fund for local government here in Victoria, and Active Super is the industry fund for local government over in New South Wales. We both had very similar numbers in terms of members and funds that we manage, and so we doubled in size. So just to give you a little bit of background there, if you in the past were used to seeing a lot of active banners everywhere, we are now the one company Vision Super. So I'm going to be running you through two different sessions today. One is making the most of your contributions, and the second is things to consider in retirement. And so they'll run back to back, but again, please feel free to type any questions that you might have in the Q&A area. We do have some staff that are monitoring that. So let's kick off. Before I do start, it is really important that everyone understands that when I run these sessions, we provide what we call general advice or general information only, which means that we're not taking anyone's personal considerations into account. So before you do act on any of these different advices that we offer you, it is really important that you make sure that they're appropriate for your personal needs. There are actually a whole heap of different services that super funds provide to members at no cost. I'm going to talk to you about some of the things that we do at Vision Super for our members. If you're not with Vision Super, that's perfectly fine because this is general information. It applies to all superannuation funds. So again, I'm going to run you through some of the different services that you can access through your membership if you happen to be with Vision Super or Active. And if you're not, simply reach out to your fund and ask them what type of services they have on offer for you. So in this particular session, what we're going to be looking at are the basics of contributions. What are the different types of contributions we can make and how might they benefit us to boost our super growth? So let's kick off at the very beginning. So, what are contributions and what are the benefits? What are some of the different drawbacks that they have? So, when it comes to contributions, they fall into two categories. They're called concessional, which is before tax because of the concessional tax treatment of those contributions, or non concessional, which are after tax contributions. The benefit of making contributions into the world of superannuation is the concessional tax environment that we can benefit from in the world of superannuation. We'll talk about this a little bit more as we go through the presentation, but essentially, any earnings that your money makes while it's invested in the superannuation world, we only need to pay 15% tax on any of those earnings, whereas outside, you're subject to your marginal tax rates. So That's some of the reasons why either making a before or after tax contribution into the world of super is beneficial to us. We also have the benefit of that compounding factor of when we start when we're younger to help boost our super growth in those later years. There are drawbacks, there are limits on how much we can put in at these different levels, and it's really important for people to understand that when you put money into the world of super, we don't make it easy for you to take out. So if you want to access any of this money in the world of superannuation, you must meet a condition of release, and there are only a few of them. So, the very first condition of release, one that most people are probably familiar with, is when we reach a certain age, and that is what we call preservation age. So, for most people, preservation age allows you to take out between 4 to 10% from your superannuation fund if you are still working. And I should say that preservation age for everyone going forward is 60. Used to be different depending on when you were born, but now all of those people are 60, so it makes it nice and easy to remember 60 for everyone going forward. So again, once you've reached preservation age, if you've got an accumulation account and you're still working, you're allowed to access between 4 to 10% of that superannuation money. On the other hand, if you turn around and tell your employer once you've hit preservation age, thank you very much, I'd like to retire, you've got full access to all of that money. And money that we're entitled to after the age of 60 is generally all tax-free money. The other important superannuation age is the age of 65. At the age of 65, we don't care if you're working or not, it is all your superannuation money. The other condition of release is one called the First Home Super Saver Scheme. So if you've not bought your first home yet, there is the ability for people to draw up to $50,000 plus any of the earnings that that money has made them while it's been invested in the superannuation world to go towards a deposit for your first home. The only catch with that one is it is a savings scheme. You're only allowed to draw down money that you have contributed. You're not allowed to access anything that your employer has tipped in. The other conditions of release are not so nice. We have things like financial hardship, where you're struggling to pay your invoices. Compassionate grounds are all of our medical reasons. If we access money under the age of 60 through either financial hardship or compassionate grounds, you do end up paying around 17 to 22% tax on any of that money that you pull out. And then you have your insurance events. So if you pass away, you're diagnosed as terminally ill, or you suffer what we call a total and permanent disability event. Those are the only reasons we're allowed to touch any of that money in the world of super. So it is important that people understand while it's a great vehicle for growing returns in the world of super because of that concessional tax environment, it is limiting in that you are not allowed to access it unless you meet one of those conditions of release. So, concessional contributions, also known as before tax contributions, and most of us are familiar with these as salary sacrifice. So, again, we call them concessional contributions because it's money that hasn't been taxed that when it enters the world of superannuation only gets taxed at 15%. Now, if you happen to be a full-time Australian employee, our marginal tax rate sits somewhere around 30+%, depending on how much money you're earning. So the best way I like to think people to think about this one is break it all the way down to $100. If you work really hard and you earn yourself $100, unfortunately, if you're full-time, you never see the whole $100. If you ask your employer to take that $100 before it's been taxed and put it into your superannuation account as a salary sacrifice, you'll see the $100 go in. The very next transaction line is always something called contribution tax, and that is the government taking their 15% out. So by the time the 15 comes off your 100, it has a real value to you of $85 in the world of super. Those $85 will then buy you units and shares depending on where you choose to invest, and those units and shares will make you money. Any money that they make you is also taxed at 15%. On the other hand, if you ask your employer to take the $100 and pay it into your bank account as salary, if you've ever looked at your pay slip, you'll see the gross amount and then you'll see all this tax that's withheld. It's part of your marginal tax. So by the time the $100 actually makes it to your bank account, it ends up looking like $70 or less. If you take that $70 and you were to put it in a term deposit and it earns you any interest, any earnings that that money makes is also taxed at your higher marginal tax rate. So that's one of the reasons that people like to put money in the world of super, because we get more bang for our dollar. So as you can see, the little diagram there, we have our salary, and we can choose to have our salary paid into a bank account, or we can have that salary paid into our super account. In the world of super, we're only being taxed at 15% tax. In the world of outside super or our bank account, we get taxed at our marginal tax rate, which for most full-time employees is around 30+%. There are caps and limitations to concessional contributions. The limit this year is the same as it was last year. It is $30,000. That includes everything your employer tips in as super guarantee, anything that you contribute as a salary sacrifice arrangement, and any deductible contributions that you make all form part of this concessional contribution cap. Now, they did introduce a fantastic rule, probably about 2019, 2020, which says if your superannuation balance is under $500,000 as of the last financial year, you are allowed to go back 5 years. And any portion of the last 5 years concessional cap that you didn't fully use, you're allowed to bring that unused bit forward and add it to this year's 30. So the government's recognised that while there are a whole heap of people out there that have been able to contribute up to that maximum amount, there's this whole other cohort. They might have been paying off a mortgage, supporting kids, that have never been able to do that. So they've let people, it's called a catch-up payment, go back those 5 years. So some people have quite a generous concessional cap within which they're able to contribute. Exceeding the concessional cap doesn't really hurt anyone these days, so the ATO will simply reach out to you if you've exceeded it, and they'll provide you with a list of different things that you can do. But essentially, all that would happen is that any amounts over the concessional cap would just be taxed at your normal marginal tax rate. Okay. So here we've got a little bit of an example. We have Mary and Kate. So Mary, 50 years old, Kate, 50 years old, both on the same annual income and both have the same superannuation balances. Mary is relying solely on what her employer tips into the world of super, which is 12% as of the 1st of July this year. And Kate, she's been tipping in an extra $50 a fortnight. So we can see when both of these ladies retire at the age of 67, 17 years later, um, that Kate's in a much better financial position because she's been salary sacrificing into her superannuation account. Now, we've got another comparison here because I'll highlight here that both of these ladies only started contributing when they were in their 50s. So Steph and Kim, 30 years old, $70,000 they both have as an annual income. Their super balance is much lower because they're younger, they haven't been working for as long, they've only got 50,000 in super. So same scenario, Steph has been relying solely on her employer contributions. Kim has been tipping in an extra $50 a fortnight, and we can see that the growth in Kim's account is much higher. So again, I'll go back to the previous slides. This also demonstrates the value of compounding. So the sooner we start with all of these little contributions, the better the effect because of compounding interest. So you're not only earning money on the dollar value that you put in, but the earnings that your earnings have made. So quite often I have people ask, when should I start contributing to super? Is there a limit? Salary sacrifice is very flexible. You can start and stop whenever you want to. There's no minimum amount. So perhaps when you're younger and you don't have many expenses, you can afford to tip a little bit more in. As you get a mortgage or a family, you can cut it back. When the kids move out, you might be able to tip some more in. And help with contributions is something that all super funds offer their members at no cost. So do reach out to your super fund if you want some help around doing some projections on what adding an extra $10 or $20 might end up looking like for you. Or alternatively, reach out and I've just got some questions, so I'm going to have a quick look at those. Hi, a little confused. Can you kind of say the retirement age is 67? I understood that it was 65. Okay. We're going to cover that off in the next session, which is about retirement, but I've just had somebody ask a little bit about retirement. So when we can access our money and when we can retire, two very different questions. When can you retire? Whenever you want, so long as you've got enough money to look after yourself. When are you allowed to start accessing your superannuation? Once you have met preservation age. Preservation age for everyone going forward is 60. If you are still working, you are allowed to withdraw between 4 to 10% from your super. If you declare retirement, you have full access to all of your superannuation. Many people get confused with the age of 67 because that is when you are able to apply for the age pension. So depending on if you're eligible or not, that has different considerations. All right, so the next style of contribution is what we call non-concessional contributions or after-tax contributions. So after-tax contributions are where we take money that we've already paid tax on and put them into the world of super. So quite often it might be money that's sitting in your bank account. You don't pay any tax on entry because you've already paid tax on that money. Um, Generally speaking, we look to people that are earning less to perhaps do after tax contributions because there are some great benefits available through the government if you earn under $62,488 a year. So we have benefits called the government co-contribution. And the government co-contribution is where the government will chip in up to 50 cents to every dollar of after-tax money that you put into the world of super, up to a maximum of $500. So again, after tax, we've already paid tax on that money. If I go back to that diagram, it enters the super account. You don't pay any tax on entry. The benefit of putting that money into the world of super is if it's invested, depending on where you choose to invest, the earnings are only taxed at 15%. The government co-contribution, great one for people that don't earn too much money. In order to get the full 50 cents to the dollar, you need to earn under $42,488 a year. And to get a partial co-contribution from the government, you need to earn somewhere between 42,488 and 62,488. Sorry. I'll clarify again, that's 47,488 and 62,488. So I always say as a rough guide, anything under sort of 65,000, the government co-contribution is a really great one to think about. So if you're casual, perhaps you're part-time, or maybe you have some kids and they might be studying and working part-time, this is a really good option for them. The other time to think of it as well is when we get into retirement, because in retirement, you might choose to do some consulting work that's not regular work, where you're just earning a little bit of money. Always think about the government co-contribution if you're earning under that 62,488. But do keep in mind that it ceases at the age of 71. So there is a limit on how much we're allowed to put in after tax, and that limit is $120,000 a year. Now we can bring forward 2 years and put in a lump sum of 360,000 in one go. And there's an even cheeky way that we can get 480 in. So if in this current financial year we put in $120,000, say at the beginning of June, and then in the next financial year we use the rule where we can put in 360, that's a way that we can get that 480 into super. So other reasons for getting money into the world of super after tax may be as we get a little bit older, you might come into a bit of an inheritance, you might have some money outside in the bank account, and as you get closer to those age 60 years, because you're then able to draw a little bit of money from super, it does become a little bit more enticing for people to contribute into super and have that concessional 15% tax on any earnings as opposed to keeping the money externally. Got a couple more questions. So what does retirement age actually mean? There really is no such thing as retirement age. It's when you choose to retire. So again, if you are fortunate enough to have enough money to look after yourself, you can be a very young retired person. Again, more clarity, it's around when we're able to access our super and when we're entitled to receive the age pension. A lot of people do get confused with that age of 65 and 67. So again, at the age of 60, which is preservation age, depending on if you're working or not, you can have some access to money within super. At the age of 65, we don't care if you're working or not. All of that money in the world of super is yours, and age pension age is 67. So there are different types of contributions that we can make apart from before tax and after tax. So a downsizer contribution is a contribution where if you sell your primary residence, so you're entitled to add another $300,000 into the world of super on top of the concessional cap and the after tax cap. So remember, the concessional cap or the before tax cap was $30,000 a year. Unless your superannuation balance is under 500,000, then we can go back 5 years and it might be a bit more generous. Our after tax limit was 120, or we can bring forward 2 years and add in 360. And then the downsizer contribution. So if you're over the age of 55 and you sell your primary residence, you are allowed to contribute another 300,000 on top of those two limits. If you bought the house as a couple, that means each of you can contribute 300,000 on top of those two limits. There are rules with the downsizer contribution. So you must be over the age of 55. You must have lived in the premises for at least 10 years. And on top of that, there are rules within which you can get the money into the world of super. So you need to get it in within 90 days of settlement. So they're quite strict with the downsizer. A spousal contribution forms part of your after tax contribution limits. So, with that one, what we're looking for is a partner that earns under $40,000 a year. If we have a partner that earns under $40,000 a year and we do an after tax contribution into their account, the person making the contribution is entitled to a tax offset. The maximum tax offset available is $540, and in order to achieve that, we need a spouse that earns somewhere between $0 and $37,000 a year. If your partner earns somewhere between $37,000 and $40,000 a year, you'll still get a partial tax offset. So again, we'll email through the calculators for anyone that wants to have a bit of a play around with that one. And this is the end of the first session, which is talking about contributions. I've got another question, so I'll just have a quick look at that one. So I've just had somebody ask the question, if somebody contributes $40,000, which is $10,000 over the cap, then how is it taxed depending on the type of contribution? So for before tax limits, remember it's $30,000 a year, unless your balance is under 500,000, in which case you can go back 5 years. So you might have more than 30,000 to play around with. If you have 500,000 or more in super, then you only have the $30,000 cap. The extra 10,000 would be taxed at your marginal tax rate. So you're in no worse or better position than you started. If it was 40,000 after tax, the limit for after tax is $120,000. So that $40,000 would go into the world of super from your bank account. It wouldn't get taxed again. 40,000 would enter the superannuation world. Depending on where you chose to invest that money, you would then get returns, and those returns would be taxed at 15%. I hope that helps to answer that. Again, if you've got more specific questions, I do encourage you to reach out to your super funds financial planners, particularly around contributions. This is an area that they will help you with at no cost. Is there an limit on how much we can contribute for a spouse if they earn under $40,000. Yes, so $3,000 is the maximum return that you'll get that 544. And remember, whatever you contribute into your spouse's account counts towards your after-tax limit. So again, get some advice on this because everyone's situation is slightly different. And it is an area, contributions, that your super funds generally give free advice around. Good questions, guys. Alrighty, so what I'm going to do now is start the second one, which is going to talk a little bit about things that we need to consider in retirement. So give us a few moments while I add the second presentation to the screen. Oh, what just happened there? No, that's the wrong one. Oh. All right, considerations when planning retirement. Again, it's really important that everybody understands what I'm running through here is general advice only. We're not taking anyone's personal circumstances into consideration. So
Sorry, Renee. It looks like we've just lost you for a moment. We'll just let you kind of reconnect. Sorry, everyone. Just bear with us for a moment. We're just reconnecting Renee now, everyone. Sorry, one moment.
Hello, I think I'm back. Thumbs up.
Yep, we
Yep.
got you back.
Sorry about that, everyone. I'm not too sure what happened there. All right, so let's share this presentation. Considerations when planning for retirement. So again, this is general information only. It is really important that everybody understands that because this information is general in nature, it does apply to all super funds, but we're not taking anyone's personal considerations into account. Do reach out to your super fund to make sure that the advice is appropriate for your personal needs. And again, there's a whole heap of free services that super funds offer members. So I do encourage you to reach out and make use of all of those. So, what are we going to look at today? Things to consider when planning for retirement. How much money do we actually need? What are some of the other things that we should be considering when it comes to planning for retirement? And when should we start thinking about it? What are some of the different services that you might be able to obtain from your super fund? So, let's have a chat about all of this. I'm just going to have a quick look. I think there's a question that's just come through. Might be. What do we need to do so that a spouse contribute is recognized as one? So with a spousal contribution, when you complete your tax return, there's actually a question there that specifies, have you made a contribution into a partner's account? Or it should be something that your tax agent asks you about. If you, for example, happen to be a Vision Super member or an active member and you log into your account online, there is a button called Make an Extra Contribution. And when you click on that to get the BPay details, it breaks it up into a couple of different options. And one of those options is a spousal contribution. So if you were going to make a spousal contribution into your spouse's account, you would get the BPay details from your spouse's superannuation account and then do a B payment from your bank account into your spouse's account or vice versa, depending on which way the money was going. Alrighty, so first and foremost, everybody always thinks about money when it comes to retirement, but it is really important that you do start to put a lot of thought into what it is that you're going to do in retirement. So, one of the things that we sometimes see, and it's quite disappointing, is people don't put any thought into what it is they're going to be doing, and then they end up sitting at home, they've lost their social network, they're not as physical as they used to be, and we can see health start to deteriorate when things like that happen. So I do encourage people to start thinking about retirement or even trial retirement through transition to retirement before you actually take that big step, because it is really important to fill that social network that you're losing when you leave work and also keep yourself busy and occupied. The other thing that I would say as well is retirement planning should start when we're in our late 30s to 40s. It really depends on what it is that you want to do in life. Some people have these great ideas of traveling with their partner. Fantastic. But if that's the case, you might want to start building up your super nest egg so that you can afford to start accessing some of that money once you've hit preservation age, or indeed retire and have that money there to be able to use to travel. The other thing I'd also say that I'm seeing more and more of nowadays is, while the job that you're currently in might be the job that helps to pay the bills and is a nice large salary, people have other things that they would like to do in terms of career journey. It might be volunteering, or a role that doesn't pay as well as their current role. So sometimes what we're seeing nowadays is people, as they start to get a bit older, because they're able to access some of their superannuation monies, they might not cut back their hours. They might actually change roles completely and go into something that doesn't pay as much as their current role. So all of these things are things that we should think about in terms of when we want to access that superannuation money and what is it that we want to do with it? What are our plans for the future? So, when it comes to the money side of things, we need to work out first and foremost how much money we actually spend. Most of us have a really foggy idea of a budget in the back of our head, but most of us have never actually written out a budget. It's quite a confronting thing to do. I've done one recently and was horrified at how much money I spend on takeout and Uber Eats. I think today we're such a tap and go society, or everything's linked up to your credit card that you just click and you don't see the dollars really coming out. To actually do a budget helps you understand where your money's going and potentially helps you to save. So I haven't stopped eating out, but I've definitely cut back. So again, I encourage people to do a budget, and I will email through Money Smart's budget planner so you can have a little play of around with that one in your own time. The other thing we need to think about is, where is our retirement income going to come from? So, is it going to be superannuation balance and perhaps some age pension? Do you have an investment property? Are you not entitled to the age pension? Might it be investment earnings topped up with money that we have in our super? Might we have some money in the bank that we're accessing in combination with money from super? So, understanding how we've set ourselves up and where the money's coming from to fund retirement is really is really important, as well as understanding if we have any of those big expenses coming up. So, one of the things that we do see when it comes to retirement planning is that in the first couple of years, people might use more money because that's when they want to go on holiday. They might want to upgrade the car before they retire. So, large expenses or things that need to be done, paying off mortgages, all of these need to be considerations when we look at the overall retirement planning. Really important as well to start creating lists of what it is that you actually need and what are some of the things that you would be happy to go without. You might want them and like them, but if we're going to retire and if push came to shove, what are our main needs? So make sure you do sort of highlight those out so that we can sort of adjust accordingly if things occur. You might need to pay off a house renovation or a leaky roof. So, maybe the dinners can get cut back a little bit. So, understanding again where our money goes and our wants versus our needs when it comes to budgeting is super important. That being said, there is a group out there called ASFA, or the Association of Super Funds of Australia, and they put together these reports every year that tell the government how much the average Australian needs if they want a modest or a more comfortable style in retirement. So, what do we mean by modest and comfortable? ASFA do a great job of explaining this, so I'm actually going to stop the share and we're going to have a little bit of a look at ASFA's website. And again, I'll email all of this through to you. So if we look at this, how did ASFA come up with those numbers? What do they mean when they say modest and comfortable? So they break it down into activities. And what I like about this is, if we have a little bit of a look here, depending on if you are relying on just the age pension, what can you afford? If you're modest and you're still renting, you don't own a home, or if you're modest and you own your home, and if you're on ASFA's idea of comfortable. In terms of private healthcare, if you're on the age pension, you're not going to have any private healthcare. If you're on ASFA's idea of modest, you're going to have a basic type of health cover and probably quite large gaps to bring those premiums down. If you're on the more comfortable side of things, you'd have that more a better level of private health cover that has quite a few those auxiliary benefits thrown in as well. It goes all the way through to how cars, holidays. My favorite is haircuts. I always laugh when I see this. If you're on the age pension, get your hair cut less frequently or try cutting your hair yourself. I've never heard of anything so terrifying for a female. If you're on modest, budget cuts only, and if you're uncomfortable, you can afford to go to a regular professional haircutter. So again, they explain what they mean quite well in these tables. The other thing that the ASFA table does, which is really helpful, is for people that have not done a budget previously, how did ASFA come up with those numbers? They actually explain to you what they based those figures on. So, what is the average person paying for council rates, home maintenance repairs, food and groceries, household costs? So, these are weekly costs, but if you haven't done a budget before, this might be really helpful when you complete that Money Smart budget planner. And the good thing about the Money Smart budget planner as well is that some of us receive bills quarterly, monthly, weekly. The budget planner allows you to put in those different values at different dates, and it does all of the hard work in the background for you. All right, so let's go back to the presentation. So again, these are guides only that ASFA has put out. Working for a superannuation fund, I've seen our planners help people retire on less, and I've seen people retire on more. Some people, they're not that interested in travel, they don't have an extravagant lifestyle. People like my mum don't understand why you pay $6 for a coffee, so they might be able to get away with modest. Someone like myself that buys a coffee every day, likes to go overseas on holidays, is going to need a little bit more. So do your own budget, it's really important. The second thing that ASFA do is they help you understand, well, how much do I need in my super fund when I decide to retire in order to generate that income? So again, depending on if you're modest or if you're looking at a couple, this is the amount that you're looking for at the age of 67 in order to have that style of retirement. So for comfortable, we're looking for a single person to have just under 600,000 or 100,000 in super at the age of 67 if they want modest. For a couple at the age of 67, again, they would need 100,000 in super for modest, or 690, getting close to the $700,000 mark, if you want a comfortable style of retirement. Just going to have a bit of a look. We've got another question coming through. Right. So ASFA revise these reports they do it, I think it's every year if I'm not mistaken. But again, when I send through the ASFA links, when you click on those links, just like the ATO and the pension figures, so when I send through the Services Australia links, every time you click on those, the new and most relevant numbers will flow through. So in short, yes, they revise this on a regular basis. All right, so working out, again, budgets are really important for us to actually understand where our money goes and make sure we have those good spending habits and saving habits as well. Again, part of growing our super, it's really important to add money ourselves on top of what our employers are tipping in. So just rehashing what we've covered in the contribution session, non-concessional contributions are our after-tax contributions. We might have some extra savings sitting in a bank account, come into a little bit of an inheritance, or you might sell an investment. It's a really good way to get money into the world of super, especially for people that are close to 60, because we can then start accessing it once we meet that condition of release. You are allowed to put in $120,000 a year, or when you bring forward, you can put in 360 in one hit. Again, our concessional contributions, they're the ones that go in before tax and only get taxed at 15% tax instead of our normal marginal tax rate, which is 30 plus. So I've shown you this little presentation before with Mary and Kate, but again, just to highlight, Mary and Kate are both 50 years old. They both have an annual income of $70,000 a year, and they both have the same superannuation balance. Now, Mary's relying solely on what her employer's tipping into super, whereas Kate is adding an extra $50 a fortnight. So after 17 years, we can see that Kate has a much healthier super balance in retirement than her friend Mary, who's relied solely on employer contributions. Now, as I was saying in the very beginning, retirement generally income comes from more than one source. Most people are not looking to have just a huge super balance and draw down from that. They might be entitled to some age pension. They may have some external investment properties. And depending on your assets and income, whether you're eligible for Centrelink, will dictate where this money is going to come from in retirement. There are a whole heap of myths out there that you need over $1 million in order to have a comfortable retirement. We've done some projections that show, depending on how much you have in super with much more modest balances, you can still have a very comfortable retirement. So the first set of columns here looks at people that are just entitled to the age pension. Currently, the maximum age pension for a couple is just over $45,000 a year. The maximum age pension for a single person is just under $30,000 a year. But what if we had a couple and a single that had $250,000 in super? So the couple combined, we might have one person has 100, the other person has 150. Under the asset test, the couple is still eligible for the full age pension. So, taking the full age pension and 6% of their combined 250 bumps the couple's income up now to $60,000 just over a year as tax-free income that they can live on. The single person, they've got 250 in super, drawing 6%, bumps their annual income now up from just under 30 to closer to $45,000 tax-free a year. What if you had $450,000 in super? As a couple, assuming you don't have many more assets under the asset test, they're still eligible for the full age pension. Full age pension plus 6% of their 450 bumps their income up now to just over $72,000 a year. A single person that has $450,000 in super, unfortunately, they're not going to get the whole age pension. They'll get a partial age pension. They'll get a partial age pension of $19,851 a year. 6% of their 450 bumps their income up close to $47,000 a year. Now, in these examples here, we used 6% because the average balance fund in Australia produces 6% per annum. In a perfect world, what we would love to see is if you're drawing 6% from your superannuation actually returns 7 or 8%, meaning that the money that you drew down for that year is not even touching the principal. And that's how we see many Australians actually ending up with money left over in retirement to pass on. So people often forget two key things I notice when it comes to retirement planning. First and foremost is they think about how much money they earn. So if I'm on $90,000 a year and I like my lifestyle, I'm going to need $90,000 every single year in order to maintain the same lifestyle. We forget how much tax we pay in Australia. It's not the $90,000 that you need, it's the tax-free amount that ends up hitting your bank account. And for most of us, our marginal tax is around 30%. So, again, it's not your salary that we're looking for. And that's why the budget is really important to put together. Secondly, we always forget that while you are drawing down money, your money's still invested. Your money should still be working for you. So even though you are pulling down some funds, your superannuation or pension accounts should be earning interest and creating income for you in the future. And that is pretty much the end of this what to consider in retirement session. I do have another question come through. Just going to have a look at that. So I don't send the slides out, but all of the information that I sent through in terms of the numbers, the calculators that I was talking about, so the budget planners, all of that will be emailed through to you to use in your own time. Again, there are a whole heap of services that you can reach out to your super fund to get assistance with. So a really good one that we introduced just after COVID was something called a retirement health check. So if you're an active or a Vision super member, you've got access to the retirement health check, which you're allowed to do once a financial year at no cost. And it's essentially working out when you can retire and how much you can look forward to in retirement. So we'll have a look at what you've got in your super. If you've got a partner, how much do they have? How much are you both earning? When are you thinking of retiring? And how much do you think you need every year in order to live? And then they will factor in things like inflation and growth. And they can turn around and tell you, yes, you can meet that goal. You can actually increase it or decrease it. It will last you until you're in your 80s, or will it last you until you're in your late 90s? So that one's the retirement health check, which we find really helps members out because sometimes they don't realize you've actually got enough in your super account to retire and enjoy the lifestyle that you want now. So if you're not with Vision Super, again, reach out to your super fund. Most super funds have some projections that they can do for members at no cost. Again, you can get advice around contributions into super. Should you be doing before or after tax? Do you have some money sitting in a bank account? And are you interested in putting that into super? When it goes into super, what investments should I pick? We can do investment reviews at no cost as well for members. When it comes to full retirement planning, we call those comprehensive financial plans. And that's where you and your partner would probably sit down with a financial planner, or yourself if you're just a single, and they work out if and when you're entitled to Centrelink. They look at different strategies that they might be able to employ, depending on if there are any age gaps between people, whether there are adult children that might inherit leftover superannuation, and how we can make that tax free. So that one's a much larger piece of work, and we do charge for that. And the average fee is around $2,500 to $3,000. That's where most of our members fall. We recommend that people do a comprehensive financial plan 6 to 8 months out from retirement. And we say that because the government loves to change the rules all the time. And we do want to make sure that you're getting the best out of the current year's rules. So I'm going to stick around for a little bit in case anybody does have any questions and you want to type those in the Q&A box. But I hope you found the sessions useful. Again, thank you for participating. Can the Smart Budget be sent? Yes, the Smart Budget Planner will be sent out.
Thank you so much, Renee. That was amazing, even for myself. So I am definitely going to share around the information and the links Renee will provide me. I'll share them around to everyone who is registered for today. But if you do have any questions quickly before we wrap up, feel free to either post it in the chat or turn your microphone on and you can ask directly.
How do I find a financial advisor? I would always say reach out to your super fund first and have a check and see what type of financial services they offer. As I said, many of those tend to be at no cost, so make use of all the free stuff you can first and foremost. There are external financial planners out there, and it is really important that people understand when you choose a financial planner, make sure you understand what fees they're charging you and whether you're getting value for money. So being an industry fund, our fees tend to be quite low and we charge one-off fees. So the comprehensive advice piece that I told you about is a one-off fee that you pay. You can come back to us down the track if you want to tweak your investments or increase or decrease pension payments. We don't charge our members again for things like that. Some external fund financial planners, they do charge ongoing fees, so do be careful about that. That being said, sometimes those ongoing fees are worth it depending on what added value they're providing for you. So only you can answer that question for yourself as to whether you deem what they're charging you as valuable. What else have we got? Just confirming, did you say that financial plans? So they roughly cost around $2,500 to $3,000. Most of our members fall into that bucket. It can become more expensive if you've got a lot of external issues that they need to take into account, but I would say most of our members fall into that category. I'd also say that the very initial consultation is always at no cost. So it's a bit of a fact find where you tell the financial planner what your situation is, what your goals and wants are. The financial planner will then turn around and say, these are the different strategies that I think would be valuable to you. This is why, and this is what I'm going to charge you. And then it's up to you whether you go ahead with that or not. So again, always reach out to your super fund as a first point of contact and see what you can get out of them. Okay, also for non-concessional payments, make sure ATO form back to the super people. Yes, so non-concessional contributions. It depends when you make a non-concessional contribution, what it is you're trying to achieve. So again, non-concessional contributions are contributions that are going in after tax into the world of super. You have already paid tax on this money, and so you don't get taxed again. Now, there is a way to make a non-concessional contribution a concessional contribution, and that's called a deductible contribution. So I'll put this into context. We might have a situation where someone's been salary sacrificing on a regular basis, and right before the end of financial year, they have a look and they go, oh, geez, I've got an extra $5,000 before I hit my $30,000 limit that I can put in. You can't go to payroll and ask them to do a one-off salary sacrifice for that amount. What you can do is do a B payment of $5,000 into your super account as a member contribution, and then lodge a form called a Notice of Intent to Claim a Tax Deduction. And what that will do is that will refund you the extra tax that you paid over 15%. So effectively changing an after-tax contribution to a before-tax contribution. Again, reach out to your super fund and get some help around this if you're confused. They will help you out at no cost. So again, that's a deductible contribution. And generally, people that might earn bonuses or want to put a bit of money into super try and do that right before the end of financial year. So you are absolutely correct. There are a couple of things we need to do to make sure that we're on top of that one. First and foremost, the money must be in the superannuation account before 30 June. If it's in after 30 June, it counts towards the next year. You can then submit that notice of intent to claim the tax deduction at any point, so long as it's before you do your tax return. But a tax agent will help you out with that if that's something that you're looking at. Is there a catch-up payment? Yes, so we explained that one. If your superannuation balance is under 500,000, you are allowed to go back 5 years, and any portion of the last 5 years concessional cap that you haven't fully used, you can bring forward and add to this year's 30. That's the catch-up payment that sort of helps people out that haven't been able to contribute up to that concessional cap for the previous years. For additional investments, do I need to contact my super fund? You can switch your investments yourself if you're comfortable doing that. If you've not done one before, all super funds do an investment or risk review at no cost. Usually takes about 15 to 20 minutes over the phone or via Zoom. So if you've not had any help with investments in the past, then absolutely reach out to your super fund and they can help sort this out with a limited financial planner. What is the total amount in super that will not affect my pension? That's going to change depending on so when it comes to Centrelink, there is what we call an income test or an asset test. So it's not just how much money is in my super before it affects my pension. It could be, are you earning any money? But very quickly, just let me see if I can find that one for you. Where are we? Here we go. So this is based on the asset test. Oh, so this is part of how much you would need in order to miss out on the full age pension. So assets, when it comes to Centrelink, are everything except the family home and any superannuation that's held in someone under the age of 67. So this, if we look at the blue column, for someone that owns their own home, that is a single person, They are only allowed to have $321,500 in assets. That includes what your super and pension balance is, money in the bank, contents of your home, the car. So it's not a straightforward question of how much am I allowed in my super before I'm not allowed any age pension. There is the assets and the income test. For anyone interested, you might want to attend one of the evening retirement seminars or planning for retirement. Sorry, not planning for retirement, pre-retirement, retirement, and we cover all the Centrelink information off in those sessions. Perfect. If you earn under 60,000 and want to maximize the additional government payments for what? Non-concessional payments. Yes, so if you earn under $60,000 a year, then the government co-contribution is useful for you to be able to contribute after-tax money into the world of super. So again, there's a calculator that I will send out, and the calculator basically will allow you to put in how much you earn and how much you would get back if you made that after-tax contribution. So again, in order to get the full 50 cents to the dollar from the government co-contribution, you need to earn under $47,488, and to be eligible for a partial co-contribution from the government, it is between $47,488 and $62,488. Under homeowner, is that owned outright? It doesn't matter if you have a mortgage or not, because in the eyes of Centrelink, if you needed to, you could sell that home. It is an asset. So regardless of if you own it outright or you're still paying off a mortgage, they consider you a homeowner.
All right. Wonderful. Thank you so much, Renee. I will let you go because I do feel like the questions will just be constant for you. But if anyone else has any other questions, feel free to send the LGEA Professionals Australia an email, and we can work with Vision Super to get a response for you. And I will be sharing out the details that Renee has said, probably this afternoon or tomorrow morning. So thank you so much, Renee. That has
Happy
been an
to do it.
amazing session.
Thank you.
All right, well, I'll wrap it up there. And hopefully you can all join us for our next session, which will probably be in a couple of months. Thank you.
Lovely. Thanks,
Thanks.
everyone. Bye.
Bye.